October has been a very tough month for global markets, especially risk assets. Even US equities and high-yield credits have erased their gains for the year. The Euro Stoxx 50 is down nearly 10% year-to-date and approaching a key support line coming all the way from 2011. There isn't just one factor behind the correction, but at the top of the list, we'd place the Fed and the 45 basis point increase in 10-year yields in early autumn. The bar is much higher for the Fed to pause than in 2015-16, given the strengths in the US economy and the clear pickup in inflation. Throughout the year, we've warned that Fed normalization would lead to a rise in financial volatility. As the Fed gets neutral or even restrictive, the correlation between bonds and stocks rises. This explains that there has been no place to hide this year. A diversified hedging strategy is of the essence in such difficult markets. The trade war is another factor. The chips crisis that has seen accusation of Chinese spying has put a lot of pressure on the information technology sector in China. EM equities are down more than 20% this year, technically a bearish market. The trade war is here to stay. At the heart of it is the long-term economic, technological, and military supremacy. The Fed and the trade war matter, if only because they have an impact on growth. The most important factor of all. The drawback in stock performance versus bonds has come as economic sentiment cooled off. Many bad news are priced in. For instance, dividend forwards now look too pessimistic. Growth in Europe has cooled off towards potential, but isn't crashing. China has delivered some monetary easing and is planning fiscal support too. The outlook will be far more threatening once the US economy starts to slow down, but we see strength into mid-2019. Credit markets tend to turn earlier than equities, yet they have been resilient. It is premature to worry about a recession. Let us conclude with Italy, an important idiosyncratic factor, but not a systemic one for now. The government has not convinced the European Commission. More worryingly, it hasn't convinced Italian companies either. The economy is slowing, and Italian financial spreads are widening, which will hurt lending. We fear the confrontation will not ease off before the European election. In conclusion, we recommend to close the underweight in stocks that we ran through summer. We stay long cash and underweight bonds, both core and BTPs. We're neutral on credits and see selective opportunities in EM. There is too much pessimism just now, but the Fed, trade war, and European dissonance do require active hedging. Good investments. Speak to you soon.